very long time. He's a wicked experienced lender, and I couldn't be happier that the three of you all, particularly, are in here because you have a whole lot that you haven't had the opportunity to experience yet. So you, I know, have some wicked good information for everybody as brand new agents. What do they do when they have this brand new buyer that they don't know what to do with?
Exactly.
Take it over.
All right. So today we'll go over just a bit. It's going to be a very high level class that we're going to do today. Just the basics of mortgage lending, kind of how the process works, and basically answering some of your questions that you guys may have as you're getting into this. There's a ton of information. We've tried to dull it down as much as possible so it's not overwhelming. But if it is and I'm going too fast, tell me to slow down and we'll make sure we get all your questions answered. All right, so about me, I am a licensed real estate agent as well. I've been in the business since 2014. I've been a loan officer since 2020. I co-own the lending company that I work for currently as well. I'm a notary public. I'm a short-term rental investor. I come from an IT background, even though I didn't know how to set up my computer today. Frequent traveler. I have a dog, a cat, and I also have some saltwater fish aquariums. So just a little bit about me. Some terms we're going to go over today. PMI, private mortgage insurance, that insures the lender against losses caused by borrowers failing to make their loan payments. That's for conventional loans. Debt to income ratio, DTI. We take monthly payments on the credit report and divide it by the gross income of the borrower. So that's how we generate that number. And that is the core number that is needed to be able to determine what type of loan they're going to qualify for and how much they're going to qualify for. Mortgage insurance premium, that insures the lender against loss caused by borrowers failing to make their loan payments. That's for FHA loans only. DPA is down payment assistance. And first-time home buyers, a home buyer purchasing their first home. However, it doesn't always have to be their first home. If they haven't owned a home within the last 3 years, they would still be considered a first-time home buyer. So that's kind of a nice little caveat there.
That was 4 years.
3 years.
Can you go back one?
Yeah, absolutely.
I just want to confirm the PMI is basically the same thing as MIP, but MIP is just FHA's name for that.
PMI is conventional, MIP is FHA. So they're both intertwined in the same type of setup, but they're just for the different loan programs. That's correct. Any other questions?
Do you guys understand when we need that?
Yes.
Okay.
All right. What does a buyer need to get qualified? This is the big thing that everybody asks all the time. So there are two different types of borrowers. There's a W-2 borrower and there's a 1099 borrower. So your W-2 borrower is simply working a salary job somewhere, at a big company. Most of the time, we would need their most recent pay stubs covering 30 days, their most recent 2 months of asset statements, which would be their checking, savings, money market accounts, retirement accounts, or investment accounts, but not crypto. A lot of people ask about crypto and they still haven't got us set up for that yet. It's coming, but it's not here yet. Most recent 2 years of W-2s. And if they own additional properties, investment properties, or second homes, we would need mortgage statements for each of those properties. If they have a mortgage statement, their homeowners insurance declarations pages for each property, their most recent tax bill for each property. And if they have an HOA, their HOA statements for those properties as well. Self-employed borrowers, it's pretty much the same situation as a W-2. However, it's a little more complicated. They typically are owning their own businesses. Us as realtors, we're also considered self-employed 1099. So we would need our last 2 years of personal tax returns, our last 2 years of business tax returns, our most recent 2 months of asset statements, and if we own any additional properties, mortgage statements, the insurance declarations pages, the tax bills, and the HOA statement. Any questions on that so far?
Do the business tax returns only apply if you have like an LLC or a?
Yeah, so it depends. Usually if you're just self-employed and you're kind of on your own, you're filing a Schedule C on your tax return. I'm not going to dive too much into taxes for, I'm not a licensed tax professional, but typically they will be filed under a Schedule C on your personal income. If you have a separate LLC that you've set up, then we would require those on top of the personal tax returns.
Cool. I was like, I would that if I needed to buy a house today.
Correct. Now, the only thing is if we see it on the tax return, we've got to count it. So if you've got it linked to the LLC in some way, shape, or form, we're going to have those returns to be able to document it. All right, the loan process. So this is kind of one that a lot of agents know, but don't completely know either. So basically what ends up happening is you send me a borrower, we qualify them, they provide their documentation to us. I review, I qualify the borrower, I provide a pre-qualification letter, and there's a big thing here, pre-qualification and pre-approval. They are basically one and the same. They are used interchangeably between lenders. As long as I've got all the documents and I've reviewed everything, it's a pre-approval letter. It's pre-qualified if I'm only looking at information that they provided us, but we have not verified yet.
That's important. Is everybody get that? Yes.
It's very, very, very important for us to have their information, and I typically will not issue any type of a letter until I have all of their information so that we make sure that we're qualifying them correctly. We don't want you guys wasting your time, and we certainly don't want to waste our time if they are not providing a true accurate picture for us.
There are some lenders out there, particularly probably some in other states and some that you find on the internet. Dude, go lay down. That will issue a pre-qualification letter, and all they've done is answer the questions of like, how much money do you make? Who do you work for? There's no supporting documentation at all.
Exactly.
And therefore they could have been completely lied to.
They filled out a form and that's, so we'd go the extra step and make sure we have all the documentation before we even get to that point. So after we've done that, you guys are free to go and talk with your client, help them find the home of their dreams. So once they sign the sales contract, that's kind of where everything starts coming together for our side. Once I've received the sales contract, I'll prepare the loan file and send disclosures out. That typically takes 1 or 2 days. After they have signed and sent everything back, I order the appraisal, I reach out to the attorney, I start getting all of the background stuff, research done that we need to do. During that time, you guys are doing your inspections and anything else that you guys have set up during your due diligence window. Our goal is to always have the appraisal done and a conditional approval before your due diligence expires. So I have people that call and they're saying, well, we need a really quick due diligence. I usually like to say, don't do anything less than 7 days. We can do it, but there may be extra costs to the borrower to expedite some of these processes as well.
Follow-up statement such comment, right? They have to sign and get that disclosure back to you, so it's also important that we make sure that they understand that that needs to be returned quickly, or else their appraisal could be delayed and so on.
Correct, and I let them know that too. I'll text them and tell them, hey, disclosures are out, you need to go in and look and sign them right away, make sure we get them back so that we can get that for you guys. So once everything's back, once we've got the appraisal ordered and title work together, my team will start reviewing all the documents that have been provided, make sure everything looks good, make sure we don't need anything additional, and basically get the file ready for us to go to the underwriter. So this whole process is typically taking, like I said, about 7 to 10 days at that. I'll reach out to the borrower and ask if we need anything else during that time as well, and just follow up and keep you guys posted on what's going on throughout the process. So after that, underwriting will review the file. They'll provide a conditional loan approval listing additional items that we will need. What we'll do at that point is we'll reach back out to the borrower. We'll let you guys know, hey, they're approved. Congratulations. Woohoo. So we'll reach out, we'll get those documents together from them, and then we'll start getting anything else we may need in terms of inspections, and we'll go over that in a little bit. But in terms of inspections or anything else. And then while that's going on, you guys will be negotiating whatever's going on with due diligence. So if there's something wrong with the house and you guys are negotiating a seller credit, you'll be working on that at that point in time and getting me the documents so we can get everything updated. So after all that's done, an initial closing disclosure is issued. That's done about 3 days prior to closing. We'll have our final approval at that point in time. Everything will pretty much be buttoned up. After we've got that signed and back, the attorney and the lender will confirm any fees being charged. We'll provide the final closing disclosure for you guys to review. I'll review it, and we'll review it with the borrowers as well. And then we get closing day. The loan's funded, your clients get the keys. And going back real quick on the closing disclosure, I know a lot of agents will ask if we don't have it out within a day or two. There's 2 different ones. There's the initial that goes out 3 days before, and then there's the final. The final can be done up to the day before, and sometimes the day of, depending on how late the day it closes. So don't worry if you're not getting that closing disclosure at the 3-day mark. It's tough, I promise. Any questions? Okay. So let's go over some different loan programs. So these are the basic loan programs that are out there. There's a myriad of others that are available, but we'll just start with the basics. So conventional loans, you need at least a 620 credit score. Your debt to income ratio can go up to 50%, but this is dependent on your credit score. The minimum down payment is 3% for first time home buyers or 5% for second time home buyers or manufactured home. Mortgage insurance is only required if the loan to value amount is 80% or more of the value of the home. So if the home, you guys purchase it and it prices at 400,000, for example, it would need to be at least, I'm going to go 500 just to make it easier. It would need to be at least 400,000 or less to not have mortgage insurance. First time homebuyer programs, they are available. There's an online class that you would need to take, and a typical loan closing time for this product is about 30 days. We can move that up a little bit if we need to, though, in special circumstances.
That NC housing that you're referring
NC housing is one of them, but we also have some different ones that we can utilize as well. So there's so many out there.
Okay.
One thing that I do try to caution people on, however, is first time homebuyer programs are obviously providing a benefit to the home buyer. They're providing some kind of down payment assistance or some kind of credit or something of that nature. Be careful because that credit's got to come from somewhere, which may mean that the interest rate may be slightly higher than what it would be with the regular loan. So we always attempt to look at alternate ways to get them to come up with that down payment before we send them into a first time home buyer credit. But they are out there, they are available, and we can definitely work on those two. All right, FHA loan. This is the really popular one. This is the one that most people go into at the end of the day. There are a lot of benefits, but there can also be some teeth to them as well. Your minimum credit score needs to be 580. We can go lower, but there are a lot of exceptions to that. And we would have to dive into what happened and basically make sure that they have enough down payment available as well. DTI ratios are 57% on this product, so it's the only loan program with the most availability to max out what they can purchase. So 57% is incredibly high, but that's great for people that may have student loans or other things, and they really are trying to get into something as well. Minimum down payment is 3.5%. This is for anybody. You don't have to be a first-time home buyer. Now, the only difference is if the credit score is below 580, the down payment goes up to 10%. Mortgage insurance for the life of the loan, it's basically 0.5% of the loan amount, and it can be high, it can be less with a higher down payment. Typically, we say that the MIP for the life of the loan is if they're not putting more than or less than 10% down. Putting over 10%, it can usually be cut down to 11 years at that point.
Okay.
Yeah.
For the life of an FHA loan, they're paying 50.55% of the loan amount.
Correct. It's built into
on a $500,000 house. That's $20,000.
That sounds right, but it's split up into a monthly payment. I mean, usually it's like a couple $100.
I don't think I even realized that never went away. I think I may have heard that, but I'm not seeing it in writing, so it didn't click.
So it doesn't go away after you've paid 20%
Nope, that's not
down?
conventional. Nope, it stays for the life of the loan, unless you're putting more than 10% down. If you're putting more than 10% down, it can fall off after 11 years. But if you are putting less than 10% down, it will be 3.5% no matter what. I'm sorry. 0.55% no matter what.
But you also could refi when you got into a situation where
Absolutely.
you had more money to buy, and then you got, but once you have 80% equity, you ought to be able to, 20% equity, you ought to be able to refi and use the equity.
Exactly.
Okay.
Yeah, exactly. And I'll go into that in just a second too, because
sorry guys, I'm sorry, Clark, to interrupt you.
That's okay.
When we have FHA buyers, this is something we want to remind them of. I always told them when you have 80%, 20%, you can refi. But they need to know that that's the only way to get that off and trigger it to do that.
Exactly. The FHA upfront mortgage insurance premium is 1.75% of the loan amount. That is financed. So whenever we're doing our loan calculations, that's already calculated in. The borrower's not paying for that out of their pocket. This is great for first-time homebuyers with higher debt to income ratios. There are down payment assistance programs available for FHA. However, it's the same circumstance. The money's coming from somewhere, so you just got to be prepared that the interest rate might be a little bit higher. Typically, there are forgivable programs with this, but there are also non-forgivable where they can pay their down payment back as a second lien over a 10 or 20-year period. There are either or options for that. The typical loan closing time on this is around 30 days. The other nice thing about this loan type that I like is they have what's called a streamlined refinance option. Streamlined refinance option basically means that I'm pulling credit. I don't care about income. I don't care what's in their bank accounts. As long as the interest rate is about a point lower, they qualify. So we can lock the interest rate at that point. We just close the loan. We don't need an appraisal. We don't need anything. So it's a great opportunity, but you're restarting your MIP at that point and all of that. So that's one thing you have to keep in mind.
Unless you refinance out of the MIP.
If you refinance out and you're paying off the FHA loan, the MIP goes away once it's paid off. You don't have to worry with it at that point. But given the fact that we are in an environment right now where people are utilizing credit cards a little bit more and they're a little bit tighter on money, having that streamlined refinance option is fantastic. I've got somebody right now that did a 9% loan a couple years ago whenever rates were really, really super high. And we were able to use a streamlined product to refinance them down into the 6s. So it really helped them out. It saved them a substantial amount of money. And we didn't have to worry about what their situation was at that point in time.
Right.
So it was fantastic. USDA loans, this is a big one. So a lot of people believe that USDA rural loans are no down payment and that they're a superior product to FHA or VA loans. They're great for the locations that we're at out here, but the problem is, and we'll go over it in a little bit, even if it's zero down payment, a borrower still has to have money to be able to come up with closing costs, due diligence money, and earnest money. Get a lot of calls where people think no down payment means absolutely no money out of pocket. That's just not the case. So this is a slightly harder program to qualify for. You have to have a 660 credit score. Your DTI ratio is only 43%. Housing prices these days, your DTI is usually going to be a bit higher than 43%. So it's a little bit of a tougher program to get into, but it is available. There is no down payment required. Mortgage insurance premium is 0.35% of the loan amount. The USDA guarantee fee of is 1% of the loan amount, and that is financed like FHA. There are income limits based on state and county and number of household members, and they count everybody in the household that has income. So if you've got a teenager that's working in a grocery store, for example, you got to count that income. If you've got somebody that's not on the loan, you got to count their income. So that's the one big thing with that. It's a rural loan product. It's only available in specific areas. So that's the other big thing. It's really good for Johnston County. There are parts of Wake County and Harnett County that'll qualify for it. I always tell borrowers that are looking for a USDA loan, give me the address before we move forward and let's make sure it qualifies. And I can provide you guys a link to the website too, so y'all can do your own due diligence and check.
So you, for the loan, I just want to make sure I'm hearing right.
Sure.
For the loan, you count the income of all of the household members, even if they're not signing
For USDA, that's correct. I don't count it in my debt to income ratio, but USDA counts it as household income. Because they're looking at whatever the maximum amount is for that household in that area, and that determines whether that loan will qualify. So there's two different ratios involved here. There's your debt to income for the borrowers, and then there's the household income for everybody.
Yeah, and this thing, like sometimes I've had people who were moving in an elderly family member who gets Social Security, and I believe that even counts as income.
It does.
And the USDA loan is fantastic, but it does have a capped income. So if you've got someone, it hovers around the 90-ish.
Depends on the number of people in the household. Right. So I mean, there's like a 1 to 4, and there's 5, 6, 7, and 8. So I always say, let's get all the income in, let's count it up, and we'll figure out if it's fine. If it doesn't, then we usually will just flip them to an FHA loan or something. The other thing is there is a 2-step process on closing USDA loans. So not only do me and the underwriters have to review the file and approve it, we have to send it to USDA to get approved. So the one thing about USDA, especially as you get later into the year, they are allocated XYZ amount of funds per year. Those funds could potentially run out. If we have a government shutdown, it could cause delay. So we approve it, we send it to USDA. It usually takes them 2 to 3 days to get back to us. they're basically signing off on what our underwriters have done, and then we can close the loan. We can't close it without USDA. So. I remember when I bought my home, I bought a USDA, I had a USDA loan, I bought my house, and I actually got mine, and then the government shut down for 2.5 months.
Yeah.
So I wasn't able to close until that opened back up. Thankfully, I had very gracious sellers, and they wanted a lot of extra money, but that's okay.
Doesn't it seem like it's always fall when it happens too? Doesn't
It was, I closed in September.
I've had some too that lasted, they string along forever, so, yeah, avoid USDA in the fall if you can help it.
Yeah, and I don't know when their funding restarts for the year, but it really just depends. So,
The government's fiscal year.
correct, it's all tied to that.
The bigger issue is the shutdown for me. I've not had them run out of money on me before, knock on wood, but I have had the shutdowns affect us.
Delay.
Yeah, because it's a government entity and they just stop working, so they're not processing all the loans. And they just keep
Exactly.
piling up, because these guys are still doing their jobs and sending them to USDA, and they're just letting them stack on their desk because they're not allowed to work right now.
Well, and the thing that gets frustrating too is if we have an interest rate lock, we could run into all sorts of problems with extending it past that point too. So it can
get sticky.
it can get very, very stressful. USDA is a great product. I advocate for it. Like I said, I have one myself and I'm happy with it, but it has its quirks. And that's the big thing. It's not a bad loan program. You just have to be really, really prepared.
I share that exact sentiment.
You just have to be prepared. That's it.
Except if someone tells you you're dealing with USDA Direct, run as far and as fast as you can.
I've done
Come
one
talk to me
USDA
first.
direct loan in my lifetime as a realtor, and it was a complete and utter nightmare. I had to get on the phone and yell at the USDA rep to get it approved because we were supposed to close and they wouldn't do anything. So
I accepted an
it was
offer
crazy.
in April and it was supposed to close June 11th and it's closing Friday, hopefully.
I'm gonna cross my fingers.
They had my appraisal for 5 weeks
What?
before they told me that it came in low.
Oh,
Yeah,
this is that same house.
it's closing Friday, I hope. I have a CD, so I feel pretty good about it, but
Just prep your sellers. If you get any type of a USDA loan, just prep them and let them know, be patient. If it's something where you're in an absolute hurry, then and you've got other opportunities out there, maybe look at a different option. If it's the home that the buyer absolutely wants and they are really, really set on USDA, we'll try to find an alternate solution if we need to. But again, I don't want you to be afraid of USDA loans, but you just need to be prepared.
no, and I've done a lot of USDA loans
Yeah.
too. And it is a very good product. But I think, yeah, you're right. You just have to be aware that you could have issues with some of these things.
Always be prepared with any loan program. You just don't ever know what you're gonna walk into, and anything that looks easy is probably gonna end up having something happen in it that you're gonna have to. So I always tell everybody, there's no easy transaction in real estate.
Mhm.
All right, VA loans. This is another very popular one. So with this one, your minimum credit score is 620. We can go as low as a 500. I have had loans that have had close to 500 credit scores before. Again, there's a lot of teeth into them. You've got to figure out why their score is so low, what happened, and there's got to be compensating circumstances.
Mhm.
Your debt to income ratio can be much higher than 50%, depending on credit score. I have had some that have approved with a 70% debt ratio, which is bananas, but it's approved.
So unsafe.
Yeah,
Well, you don't, I mean, also you gotta think.
They're not buying up to 70% of their debt to income as the house, but still, that's.
Well, you've got to think about it too, if they're retired or if they're on social security or something, 70% may not be that much at the end of the day. It could be $100,000 house, they're just get into something, so. They do allow compensation on that. There is no down payment required, there is no mortgage insurance, there is a VA funding fee unless the borrower is exempt. And we researched that and we'll know that up front. But if they're not exempt, the VA funding fee is 2.15% for first time use and up to 3.3% for subsequent uses.
and that's financed, right?
Correct. It's a great loan program for military veterans, active duty service members, National Guard, reserves. Typically, it takes about 30 days to close. There are some special inspections that are required with VA loans, and we'll go over that in a few minutes as well.
Sorry, I have a quick question.
Absolutely.
Did I hear you say that with the VA loans that it does require down payment? Because I thought it was no down payment.
No down payment required. No,
Okay.
no down payment.
There's no down payment, but there may be other closing costs, and that's where it gets confused, Tinsley, is,
Oh, okay.
can you hear me? Yeah, because down payment is different from closing costs. Down payment says I've got to put 3.5% down for an FHA or 10 or 20% for conventional. Those things aren't required, but there will still be closing costs.
And we're gonna go over that in a minute, just so that you've got it. I've got a slide for that. So, but yeah, I mean, no down payment never means that they're walking away from this with no money out of pocket. There are some circumstances where they can get some money back at closing, but they're always gonna have to have money on the front side for due diligence, this money, inspections, things of that nature.
Thank you for confirming.
Absolutely. All right, other loan products. We're going to be really brief on this one because there are 1,000,001 different alternate special loan programs out there. So I have a lot of self-employed borrower loans. There are a lot of self-employed borrowers that will not fit into a conventional loan or a government loan, government being USDA, VA, or FHA. So in those circumstances, it may be because they're writing too much off on their taxes. They took a loss. They just started a business a couple years ago and took a loss one year and maybe profiting this year, but it just doesn't add up. So in that circumstance, we can do bank statement loans. I can look at their 1099s and formulate their income alternatively to come up with a different number. So there's that. There's also some no document programs out there that we can look at as well for them. We have investor loan programs. Conventional loans are always going to be the best way to go, but you can also do a debt service coverage ratio loan, which is a fantastic product. I will briefly go into that. A DSCR loan is basically where we're qualifying a borrower off of the rental income of the house. So the appraiser is going out. They are giving us an estimate on what the market rent is going to be for this property. As long as that number is greater than or equal to what their mortgage payment is, and they have the down payment that's required, they qualify. Not worried about their income. We're only worried about making sure they have the down payment they need and that the property qualifies. That's it. We also do I-10 loans. And like I said, every borrower has a different circumstance. There are so many different options out there. I just say if it seems questionable, call and ask, and we'll see if we can find a solution for them.
So do you like to consider yourself somewhat of a magician?
Yeah.
Okay.
I'm
that's
always a
good to know.
magician. I always wave the wand and usually, well, I shouldn't say usually, it always goes through. You know, as long as we've got a solution for it, we'll find a way.
Well, we keep talking about, Caitlin and I redid our mission statement for the team recently, and we talk about, we don't see no as a obstacle. We see it as a path to find a different way forward. And I'm one that I don't like to take no. If someone says they don't qualify, I'm like, but do they really? Like, can't we try?
There is never a no. There is always I like to say there's never a no, but it's always a maybe. And that maybe may mean that we have to wait a few months, but there's always a path forward. Let's try to figure out what that.
I like hearing that part. Thank you.
That's
Yeah,
right.
that's
I
how-
told to everyone as well, even during my consult, I said, listen, let's call the lender. As soon as you're even thinking about being ready, because if it's a no now, it's only for now.
And then you know where you gotta
what
go.
you need to
Well,
do
yeah,
to
let
get
us-
to yes.
Let
That's
us
right.
look at everything and
I love
figure
it.
it out, because there might be
It's the same.
something where we need to improve a credit score, we need to pay off something, we need to get a second job if that's what they want to do. There's different things to make it work.
That's right.
You just gotta make it work.
And
And
just
no
so you
question,
guys-
stupid question either. That's the other thing.
Good.
That's right.
Just so you guys know too, we, as you know, we're not like tax advisors and accountants and lenders and all that stuff. But I do feel like, oh shoot, where was I going with that? Oh, I completely lost it. Keep going.
We're talking about tax advisors, or you're talking about,
No, I wanted to say something about, what did you say right before that?
no question's a stupid question?
No,
I said, he said no's not a no, it's a maybe.
no, I'll come back to it. I'll figure it out.
Okay.
You keep talking.
Alright, okay. The goal is to help y'all close as many deals as possible. That's the big thing at the end of the day. So if you don't think there's a program for it, there might be a program for it. You know, the only barrier to a unique circumstance is how much money does the borrower have to put down, and are they willing to potentially deal with the higher interest rate temporarily to get into the loan, do what they need to do, and then refinance later. That's one big thing. You know, I like to tell the clients that your situation's temporary and the loan's temporary as well. You can always get into it and refinance it into something conforming later on down the line. As long as you've made 7 mortgage payments, after that point, we can refinance. And we can do that an unlimited number of times. As long as they have the closing cost money, that's all they've got to worry about.
Right.
Marry the house, date the rate.
Exactly.
So there's closing costs that they refinance?
There can be, there are some ways to finance it in as well, depending on equity, but typically there is closing costs, and typically it's about the cost of a payment, 1 month's payment.
It's not typically as much as when you purchase and refinance.
3%.
Correct. It's not 3%, no, it's typically like around the 1 month payment mark is what we say.
Okay.
And the other thing to think about too, whenever you're doing your refinance, you have an escrow account that's sitting there that's got money in it more than likely. Once we've paid off that loan, whatever's sitting in that escrow account is being refunded to you within 30 days. So typically, if you've got more than a month's payment in your escrow account, you're netting it out. Yes, you're coming up front with it, but within 30 days, that money's coming back. All right, down payment and closing costs. Loan programs that offer no down payment or down payment assistance still have closing costs. This is the big misconception out there. I get this call from borrowers on an almost daily basis. I need something with no down payment. Okay, do you have the due diligence and earnest money? Well, no, my realtor told me that there's no down payment. No, that's not the same thing. And you've got to make sure you have that money, because a seller in this market is not going to take anything without due diligence money. They're just not. So they have to be prepared for that. Be it $500, be it $1,000, whatever it is, they've got to be prepared for that. So I'll tell the borrowers that typically you need to have maybe $2,500 to $3,000 sitting and available. That gives you a little bit of buffer for your due diligence and earnest money. That gives you some room for the inspections. Some inspectors may allow you to funnel that over to closing instead of paying it up front to help out, but most won't. So.
And I don't recommend even trying, because if that house falls apart, they're coming after you for that fee.
Well, no, they'll come after well, it depends. It
Depends. That's
Yeah,
why I
should say
said
it depends.
I stopped managing that a long time ago for my clients, because if my clients weren't gonna pay it, I felt obligated to, because this is my preferred provider. And I know they did a job and they deserve to get paid. So that's what I was more referring to. They won't come after me for it. But if my client defaults and they can't get it from them, I always feel like I need to take care of that.
You definitely don't want to set yourself up for that, but in some circumstances.
Every once in a while,
if you're and you're comfortable with it, there might be options to be able to correct that. But we really want to make sure that the borrower has that money and that they're comfortable with that money being out there and possibly losing it.
Yeah.
That's the other big thing they've got to be worried about. Sellers can help offset closing costs by offering seller concessions, and we'll go over that in just a second. FHA and USDA loans, they can do up to a maximum of 6% of the purchase price. VA is 4%. Conventional has kind of a tiered structure. So if somebody is putting down less than 10%, you can do up to 3% closing costs. If it's 10 to 25%, it's 6%. If it's greater than 25%, it's 9%. So it tiers up based off of how much the borrower is putting down. Closing costs typically will run between 2 to 4% of the purchase price of the home. So that's the other big thing as well.
So when people ask you what's closing costs on a $400,000 house, what's your answer?
Are you asking us?
4%, that's what I'm saying.
So it would be $8,000 to $12,000 is what we're ballparking in our brain. Clark, what are some of the variables that affect that?
So inspections are one thing which you have to be prepared for. I mean, depending on, and we've got a slide for that in a couple.
Okay, I'll just
So, variables that could come into play are how much taxes are, the prorations that come out of things. Homeowners insurance is another big. I always try to estimate that a little bit on the high side, but we don't ever know what the way the market's been right now as well. Again, inspections could be one big thing, depending on what type of inspections the borrower needs. That's pretty much it.
It could also be if you know that their DTI is high, wouldn't that affect it, because their rate might be a little bit higher, which means that their prepaids might be a little bit higher.
It might adjust it slightly, but typically we're already well ahead of that before we know, because we're going to talk to them before they get their letter to make sure that they know what the monthly payment is and that it's a rough number, but they need to be prepared for if that is fault. Okay. But yeah, we always want to make sure they're aware of that. All right, inspections. Tracy, I know you asked me about this specifically. So, all right, so big thing, manufactured homes. We are seeing a lot more sales of manufactured homes these days. You always have to have an engineer certificate, no matter what loan program you're going into. So the engineer must inspect the foundation of the home. If there's been a deck or a lean-to or porch or anything added, they'll have to check that as well. The engineer certificate can cover both inspections. That's a wild card. That's one of the variables with closing costs as well, potentially. These inspections can run up to $1,500, depending on where it's located in the engineer. The one thing I will say from the real estate side is be ready that it's going to take a bit to get the inspection back. So when we go under contract on a manufactured home, we're going to want to go ahead and get that engineer certificate ordered right away. I know that a lot of engineers will take 2 to 3 weeks potentially to get that back. We can't close without that. Yeah.
If it's an existing loan that required an engineer cert and they have a copy of that, can that be used or we have to have our own?
It depends on the time. It depends. You could be able to, if it's recent. I can check to see what the guideline is on how many
Okay.
months, but a recent one we may be able to do. FHA loans, really, there's only a water test if the water supply is anything other than city or county services. So well water, shared well, things of that nature would be what would be required for a water test. VA loan, it's basically the same thing. However, we also will require a termite inspection, and that would be on not only the home, but sheds or any other structures that are on the site. So we get a lot of these where the realtors will go out, they'll proactively order the termite inspection, but we'll only get it for the house. We'll get the appraisal back and see there's a shed out there as well. Well, now we've got to pay an extra charge for the inspector to go back out and give us. So we always want to make sure that it's for anything on the property.
And if you're doing any kind of government, VA, USDA or FHA, correct me if I'm wrong, and that shed has any issues at all, they treat it just like the house.
Correct.
Yeah, so if the shed doesn't have a roof on it, they're not gonna care for that, you're gonna have to put a roof on the shed in order for it to qualify. Right?
There are some rules and limitations. And I
No,
think
right,
they're
but
starting
as a
to-
general rule for somebody, when
Yeah.
they know their buyer's getting FHA and there's a shed on the property, make sure the shed is in decent condition or it could.
Exactly,
It's
it's gotta be decent, right? It's got to, if it's structurally supposed to be a shed, it's gotta have a roof on it. You know, as we're really looking to see, and I'll go over this in a second as well, we're really looking to see what an appraiser might catch as well. So I'll walk over that in just a second. USDA loans, water testing, that's the only other thing, same situation. If it's private well, or if it's a shared well, something of that nature, we will require an inspection. The other thing, and I am gonna check on this, but I'll go on ahead and mention it. I know that out in Clayton, they've got like Aqua or some company that does the water. They may need a water test because they're a publicly owned company and not a government company. So I'll check on that, but I saw a note there and didn't hear back from the underwriter.
I think they do, but I think you can pull it from their site because they test.
They have it tested, yeah.
Uh-huh.
Yeah,
So you can pull the most recent test and that's usually how it's handled in my
exactly,
experience.
exactly. I
So my
think,
client doesn't have to have the test because they've already tested it as long as their test is current and.
as long as
okay.
we've got an accurate copy of it, we're fine either way, but that might not be an expense that a borrower has to come out. Correct. Any questions so far? All right, so here's a couple of things that we'll go over about home inspections. Home inspections are highly suggested for your clients. However, I don't want to see your home inspection report. I never want to see your home inspection report. I will never ask for it up front. Unless an appraisal or sales contract or title review reveals an issue that may require us to review it. So the underwriter is going to be looking at the sales contract, for example. Say that you wrote in there that seller is to pay for a termite inspection and a home inspection. Well, if they're going to pay for it now, we do want to see the reports. So you don't ever want to ask for them to pay for XYZ inspection. Just get a seller. Just ask for a seller concession. If an appraisal or title review reveals a concern like a leaky roof, rotten wood, panels, frames, stuff of that nature, we may ask for an inspection of and repair of the concern prior to closing. We won't know until we see it. If we ask for it, just get us what we need. We'll do what we can to try to make it as easy as possible for the client. Any questions on that? Did I get everything you wanted?
Yeah, I decided to keep my mouth shut. I know, it's really weird, really rare.
That's all right. I'm here to help. So I provide a wide variety of loan programs. I create game plans. We don't just sit here and say you're approved or not approved. We come up with a solution. And I'm here in the office. I'm over by the printers and copiers. If you need something, I'm the office with the two giant monitors. You may think I'm there, you may think I'm not, but if the light's on, I'm there. And that kind of is it for my presentation. You guys have any questions? Anything else?
What's your contact info?
You don't have one of my packets. I'll get you one. I've got my business card in it.
There's a whole packet of goodies here.
Thank you.
Yeah,
So that has some different loan programs. It has a cheat sheet on closing costs and a few other things in there for you guys from while you're out there. If you have any questions, you can always reach me anytime. You can call or text, email, whatever you need to do. But happy to help out when we can.
what are your rates for your independent contractor and your stated income? Are they terrible?
They're not terrible. They're not fantastic, but they're not terrible. It depends on credit score and what we've got going on in loan to value. I mean, I can get some stuff down into the high sixes, but you're typically looking mid to high sevens would be my
Okay.
guess. Somewhere in that.
Okay.
So, and that's the other thing with the debt service coverage ratio loans. I'm getting a lot of investors right now that are looking for Airbnb properties, for example, things of that nature. So one thing you can do to get your interest rate lower is to go in with a prepayment penalty. So they usually have between no prepayment penalty and a 5-year prepayment penalty. And every year in between there can lower your rate a little. 5-year prepayment penalty obviously will give you the lowest rate. No prepayment penalty will give you the highest interest. However, what they're trying to do is lock you in. So a prepayment penalty may be 6 months of interest, for example, that would need to be paid if they refinance, pay the loan off early, any of those things. It really depends. We just look at it on a case by case basis. But I tell clients, you know, if you take the longer prepayment penalty and the 6 months of interest is really not that much, take the prepayment penalty, get the lower rate, wait for the rates to come down a little bit. Let's reevaluate it and see if it makes sense to refinance and just take the loss on it. So that's just something that you might be able to do creatively to get some investor buyers in there as well. That's all I've got.
Any other questions for Clark?
I had one question.
Absolutely.
Maybe if you have folks that come to you that are interested in lending, but they don't really know, you know, one thing from another thing. Do you sit down with them and walk them through, or if they come in saying, I want this, but really that's the only thing they know about? Do you have a way of like walking them through, like you could get, this is what it looks like,
Different loan programs?
yeah.
I educate as much as I possibly can because I get a lot of clients. I deal with a lot of first time home buyers. And I deal with a lot of people that believe they understand it and they don't understand it.
Yeah.
So we try to walk them through it as best as we can to explain what the different options are and why we're putting them in this program versus this program. Obviously, it's up to them at the end of the day. If they want to stick with what they think is right, we'll go with it. But we always try to give them the option and make sure that they understand why we're doing what we're doing.
It's a good question.
And the other thing too, from the real estate standpoint, it's good to have somebody that's got a little bit of a real estate background as well, because I've been able to help with, you know, giving you guys some insights on what you might be able to do to help craft your offer better, to get it in and make sure that the seller is going to accept it. You know, and things of that nature to be able to try to help you guys win the deal at the end of the day.
Nice.
That was really great. Thank you.
Thank you, Clark. Thank you. Are y'all's heads spinning?
I want y'all, yeah, I mean, it's a ton of
It's over my head, and I'm kidding.
It's so much. I mean, that's the one thing you sit here and you try to make a presentation for it, but it's so much information.
Well, and it's just gonna depend on your borrower, your buyer, and that's where I send them immediately to the lender, immediately.
Yeah.
And I think I've told all of y'all this, but I put it to, most people are payment conscious, especially your first time home buyers, because they've been paying rent this whole time and they've been told what their rent is gonna be. They've had no say. So when you ask them, what is your comfortable payment range? That's when I say, let's get you hooked up with a lender, because they're the ones who are gonna tell you based on your particular situation, how much house you should be looking for based on the monthly payment you wanna have. I didn't say anything about, do you have good credit, bad credit? I didn't say anything about how much money do you have down. I said, I need you to talk to this guy who's gonna tell you, if you wanna spend $2,000 a month based on your situation, you could buy a $400,000 house, and now we have our marching orders.
And the thing that I always tell people, because you get a lot of this isn't that, the answer is always it depends.
That's right.
There's never a yes or a no, it's always it depends. We've got to see the whole circumstance, we've got to know what's going on.
Right.
And-
Oh, and I know what it was.
Yeah.
I knew it would come back to me. Sometimes you were talking about, tell them it might be they can pay something off or do something to make their credit situation instantly better. we don't ever want to advise them to do any of that because it can actually hurt you to pay off something really small that you think is helpful and it ends up making it worse.
Let us figure that out. We'll tell them because we've got the tools to be able to say, yeah, doing this might help, or no, this one might be your lowest card with the highest payment. So pay the lowest card off instead of this card with the higher payment. Let us.
They'll tell you that formula so that we're not trying to guesstimate that and making it worse, but there always is something they could do. There always is.
There's a path, and we have a wayfinder is what they call it tool where we can go in and forecast what a credit score is going to be after we pay off particular items, and it will tell us what that score rate should be if we do X, Y, and Z. And it gives us a timeline as to when that score is going to get to that point. So we always try to, if we've got an issue with somebody, we'll always try to work through that and explain to them this is what they need to do to get there.
And this is another good reason, if you have somebody who says, well, I'm still a year out. First of all, we don't know why you're a year out. That may be that they think they have to be a year out and they don't. But I would get them to a lender right then, because whatever idea they think is their year out, the lender may tell them, you're better off to jump now, or in a year, you're not going to be ready. I mean, you can have a clear map when you get to the lender at the very, very beginning of your search.
And there's one other thing I will say too. They may have also said that they've spoken with a lender and the lender said, I get a second opinion. Just get a second opinion.
Mhm.
I mean, just because every lender is different in their capacity and ability. Some also have what's called overlays to guidelines. So those overlays may be more restrictive than what our guidelines say. The beauty with my company is we follow just the guidelines. We don't have any extra. So, they might have talked with somebody that had an overlay where their debt to income ratio was going to be lower, whereas I qualify it because I have a higher limit.
Right.
So there's just things there that you always, if someone comes to you and says, we talked to somebody, it doesn't make sense, or they say to wait a year, gets.
I have something to add too on the subject of maybe a budget conscious, like a monthly budget conscious buyer, especially if we're shopping and we're worried we're like approaching the maximum. Typically what I do after my client like signals to me like this is the house, other than calling the list agent to ask questions about writing an offer, I call our loan officer that the client has determined they want to use, and I say, can you run this address at this estimated price and tell us what their monthly payment looks like? And I'm also not against, if we're really worried about, you mentioned the insurance and closing costs, also connecting with my insurance agent and saying, hey, based on the RPD, I know XYZ details. Could you give us an estimate of what that looks like? Together, we're building that team, and now we can help our buyer go more consciously, confidently forward because we have an estimate from the lender that says, based on everything that you guys got together, it's the $2,000 a month, and that's right where they wanted it to be. I'm like, great, love that.
Always tell the clients.
That's right.
I always say, text me or call me when you found something and you're in love with it. And let's look at it before you write an offer. Let's make
That's
sure
right.
that matches.
We don't want them to have to put down that deposit and then walk away because they got scared of their payment, which I'm afraid happened to someone in our sphere lately.
And it does happen. And there are some clients out there that are very insistent on doing that. You got to do what your client wants at the end of the
That's
day,
right.
but always try to sway them and
Protect
talk
their
to them.
money.
Exactly. We're here to help. We're not here to try to make them spend needless amounts of money and lose it. That just doesn't work. Doesn't work. The other thing I will say too is if you get a borrower that comes in and they've got somebody that is out of state, that's another big thing. Just be cautious with lenders that are out of state. Make sure that you've vetted their process, that they have actually reviewed documents and that they've not just filled a form out on a website and got a letter. That's one big thing you got to be cautious of.
Even with that out of state, a lot of times I find they don't know how we close things here. They have no idea what our insurance. Yeah, there's so many nuances that I've always said this. It's funny that you actually do work in my office now because since I've been in the business, I've said I prefer to use a lender that either you or I has a relationship with rather than someone somewhere else in the world, because if I know who it is and there's an issue, I can go knock on their door. I know where they live.
Exactly.
I know where they live and I'm gonna go figure out what's happening. But if I've got to call somewhere in, Wyoming, they see 919 and they ignore me all day long because they know they can on their caller ID because I'm not coming to knock on their door. So.
And they may be licensed in 20 or 30 states and don't know
And
the
they can't
nuances
keep it
of
all
North
together. So
Carolina.
I definitely always recommend at least one second opinion from someone local and
Exactly.
then let them choose who they want to. But a lot of times I think it's more beneficial to have the local person because frankly, Clark's gonna work really hard for you guys. Because if you do a better, if he does a good job and your clients are happy, you're gonna send him more clients. The guy in Wyoming could care less about me or you. It's a number. You're just a number to them.
It's a number on a spreadsheet.
Yeah.
That's it.
Yeah.
Mhm.
Cool. Anything else for Clark?
Oh, that was fantastic.
We appreciate you.
Absolutely. Thank you
very
guys for
much.
being my dry run. I appreciate it.
Can I take an extra one of these for?